Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. A nation in 25 years investing with more than a decade as a professional analyst, I have never seen a week with as many potentially market-moving headlines. We've got earnings sending stocks surging or crashing down 10 and 20% in a single day. We're going to see inflation data and jobs data this week that could spook the market. The Fed and Chair Powell are sure to set off a tweet storm with a pissed-off president when rates stay on hold on Wednesday. Oh, and there's a little matter of a tariff nightmare coming on Friday. I'm going to highlight all this, show you what to do, and reveal 7 stocks that could break out in that tariff strategy, along with important updates to SoFi Technologies, Robinhood Markets, and Coinbase. But first, investors are always asking me to review their portfolios, and now I'm doing just that, but only over the next month. It's part of a research project I'm doing to understand investor behaviors and help you better invest. If you're interested, use the link I'll leave in the description to learn more. On that page, you're going to share your investments you've bought and sold over the last 3 years, along with your goals and your risk levels. With that, we'll be able to see if your actual investments match your goals, if you're selling too early or too late. I'll then personally review your investing strategy, highlighting risks and opportunities, and give you an actionable suggestion to align your goals. I'm not trying to sell anything here, and I won't try to when we talk. I'm going to be using this data to research investor behavior, so you're also going to be helping out other investors. But I will never share your name or your data with anyone. This is going to be a big project, so spots are limited here. If you want in, look for that link below and get your free one-on-one analysis. Back to our main topic though, and August 1st could be a turning point for the market with a hard stop on the tariff pause and rates as high as 50% on some products. President Trump and those around him have already said there will be no more extensions, and while investors seem to be eating tacos, sending the market to a new record, do you really want to be playing chicken with your money? But then for the right companies, those making their products already in the United States, it could be rainbows and unicorns. Higher prices for competitors and higher stock prices for their own shares, so I want to dig deep into the tariffs to highlight the 7 stocks you need to be watching. Now, looking out at that big picture, Trump has had a hard time signing his 90 deals in 90 days that he announced in April. China and Japan have agreed to frameworks of a deal that would see Japanese products taxed at 15%, while the final rate on Chinese goods is still being discussed. The EU, Canada, and Mexico, our biggest trade partners, are progressing to some kind of a deal, but face rates as high as 35% if none is reached by this Friday. More importantly though, and really forgotten by most of the market outside of these deals, Trump has instituted industry-specific tariffs on steel, copper, cars, and has threatened to roll out tariffs on pharmaceuticals, semiconductors, and lumber next. It's here where we see the most winners because these tariffs aren't likely to be negotiated away by an individual country. These tariffs are coming, and I want you to be ready with the stocks that are going to benefit. One of the biggest moves, the president is threatening tariffs as high as 200% on imported pharmaceuticals, aiming to force drug makers to boost U.S. manufacturing. Markets have largely shrugged this off, though, on rumors that companies would be giving years before facing this highest rate, and that might be true, but when the announcement is made, it could see generic drug makers like Teva plunge while boosting others. Specifically here, Eli Lilly, ticker LLY, already has major U.S. production and would benefit from protection against generics, which are mainly manufactured overseas. Thermo Fisher Scientific, ticker TMO, would also benefit on its lab tools and specialty chemicals, many of which are also being targeted in the tariffs. Now, potentially the biggest market-moving tariff announcement would be a 25% proposed rate on semiconductors and related equipment. Chips were exempted in tariffs earlier this year, and Trump has used these exports as a carrot in negotiations with China. But any announcement on new tariffs would affect everything from cars to appliances to phones. Intel, ticker INTC, reported another horrendous quarter last week, seeing the stock plunge almost 10%. But significant chip fabrication in Arizona, New Mexico, and Ohio could make it a winner if these semiconductor tariffs are announced. Micron Technology, ticker MU, could also benefit as one of the few domestic companies with U.S. chip fabrication and really strong federal support. Tariffs on imported copper go up to 50% starting August 1st, triggering a global scramble to pre-clear shipments. The tariff threatens to raise costs on everything from cars to infrastructure and consumer electronics. Shares of Freeport-McMoRan, ticker FCX, are up 16% this year, but should benefit further as the top domestic producer of the metal, with mines in Arizona and New Mexico. Steel imports were one of Trump's first targets, doubling the tariff to 50% effective early June. Continued tariffs are going to pressure appliance and automakers, but has already benefited Cleveland-Cliffs, ticker CLF, and its 100% U.S. production of flat-rolled steel. And here, tariffs on lumber would be an easy one, given Trump's contentious relationship with the Canadian government. An investigation started in March, so is likely to wrap up soon and could recommend raising tariffs on lumber, especially Canadian softwood, to a threatened 25% rate, and hitting companies in housing and construction. And while it does have some Canadian exposure, Weyerhaeuser, ticker WY, should also benefit from higher prices on lumber from its 10.4 million acres of U.S. timberland. And now looking at the stocks I'm watching this week, it's going to be a huge week for earnings. First up with SoFi Technologies, ticker SOFI, reporting earnings on Tuesday after a massive 192% run in the stock over the last year, but now having trouble moving past that $21 price and a price-to-book valuation of 3.5 times, which is very expensive for a bank stock. Those of you in the nation know I started recommending SoFi when it was back at $6.50 a share and trading at just 0.8 times price to book. And I get nervous on valuation anytime a bank stock moves beyond 1.5 or 2 times book value. Our revenue is expected to keep growing at a 20% plus rate, and I still think the company has that competitive advantage in online banking, but just cannot recommend buying more until it comes down a bit. ARM Holdings, ticker ARM, already up 30% on the year, should have more good news when it reports earnings on Wednesday, with expectations for 13% sales growth and 19% full-year growth. The chip architecture company is a prime beneficiary of increasing investment in AI, with Google parent Alphabet keeping up that race, boosting its spending to $85 billion just this year. Our shares are definitely not cheap here at 42 times on a price-to-sales basis, so I would be holding a little back to buy any dips, but like Nvidia, ARM has a strong competitive advantage in this AI theme. Meta Platforms, ticker META, and Microsoft, MSFT, continue the big tech reports on Wednesday, with both stocks near their all-time highs. Microsoft is expected to post a steady 14% revenue growth this year and next, and is working hard to incorporate AI into its products, but I just don't see any big news in development. The company has publicly been at odds with Sam Altman's OpenAI and its investment in that company, and there just doesn't seem to be any big surprises on the horizon. It's not cheap here at 14 times price to sales, especially on only 14% sales growth, so I'd hold off on this one. And while Meta is also expected to post a similar 14% sales growth, the shares are cheaper here at just under 11 times price to sales. I like the company's developing story in advertising. Zuckerberg laid out plans in May to pretty much take over the advertising industry through its AI tools that would help it dominate the trillion-dollar spending. Up 58% over the last year, we usually see Meta consolidate a little lower after these big moves, but I would be buying this one piece by piece over the next few years. I'm also watching Robinhood Markets, ticker HOOD. It's going to be reporting its earnings on Wednesday, and I've got to admit, I have been wrong on this one. You see, in the past, I've called out a high valuation on the shares in an industry with very low margins and high competition, along with what seemed like limited products, and have avoided the stock, only to miss out on a 180% run this year alone. Here lately, Robinhood has moved quickly into tokenized assets, starting its tokenized stock projects in Europe, and what could be a huge growth driver. Sales are expected up 27% this year, and to continue that 20% pace, though high capital spending is likely to weigh on its profit growth for now. Here, Coinbase Global, ticker COIN, reports Thursday, another company that has surprised everyone with its aggressive move into new products. Its core market exchange is a competitive advantage over other crypto platforms in its regulated U.S. access, and as co-founder of the stablecoin issue Circle, Coinbase has a lottery ticket into that next era of digital money. A forecasted growth isn't anything special here at just 12% this year, but I think it can surprise on the upside as more investors get into crypto and that stablecoin theme builds on. That's going to help it justify the high price-to-sales valuation of 15 times revenue, so this is one I would be adding to regularly, especially on any dips. Showing you the bigger picture here with the Sector Spiders Sector Tracker. All 11 stock sectors closed higher last week, though with surprising weakness in the tech stocks, the usual winner in an up market, which might show that expensive valuations have caught up with the sector and are limiting its further returns. Stocks in the healthcare sector are finally getting the attention I've been talking about, the best performer last week, and for good reason. The sector is expected to post the third best earnings growth at 12.4% this year, only behind profits for tech at 18%, and communication services at 16%, well above the market average of 9.6% growth. Healthcare stocks are still trading at attractive valuations and are the only sector in the red still for the year. Now, a bigger trend I noticed over the last week was the extreme gap in returns for winners and losers. Stocks beating their expected earnings and upgrading full-year outlooks have been rewarded with double-digit returns, with 18 stocks in the S&P 500 jumping more than 10% last week alone, and 85 closing at least a 5% gain. But on the other side of this, the companies that haven't provided that rosier outlook have been slammed, with 8 stocks suffering double-digit drops and 28 falling 5% or more. So this earnings season is definitely bringing out the volatility in individual stocks, and that could spread to the broader market this week. That's because updating our market outlook, it's earnings, tariffs, and Fed meetings, oh my. This is going to be the biggest week of the year for stocks, and it's going to take the trifecta to come out with our sanity. Seriously, folks, outlining the important data coming out this week had my head spinning. In more than 20 years investing, I have never seen a week so packed with potentially market-moving headlines. We're first going to see the advanced report for June U.S. trade deficit, and while this is usually a non-event for the market, the expectations for increasing the trade deficit to $101 billion from $96 billion in May sure to be fodder for President Trump to ramp up tariff threats. And that's going to make investors all the more nervous for Friday's deadline on that tariff pause. Then the Federal Reserve wraps up his meeting on Wednesday, and with market odds almost unanimous that the Fed is going to keep rates on hold, 97% likely according to the CME FedWatch tracking, it could be the last straw for Trump on his patience with Chair Powell. Now, the market still sees a rate cut coming in September and the December meetings, but to be fair, with inflation rising to almost 3% in last month's CPI report and the job picture still holding up, I don't think Powell and the Fed should be cutting rates here, but Trump has been extremely vocal on his dissatisfaction. The two got into an historic disagreement in front of the world about renovation costs last week, and even if the president doesn't fire Powell, no rate cut on Wednesday is sure to set off a tweet storm that could spook the market. We will get another piece of that puzzle with the personal consumption expenditures, the PCE report on inflation Thursday, expected to show that core inflation remained at 2.7% pace over the last year, although the headline number and the month-over-month numbers are expected to show some upward pricing pressure. Now, this is the preferred measure of inflation used by the Fed and justifies its stance against those rate cuts. The central bank has set a target of getting inflation down to just 2%, and while it also has to protect the job market, it's hard to justify cutting rates when inflation is inching further away from its targets. Tariffs are just starting to increase prices, and with higher tariffs to come, I think even the September rate cut could be in jeopardy if we see those tariff rate hikes go much higher and inflation come in hotter, which would definitely weigh on stocks. And then the monthly jobs report comes out on Friday with forecasts for the U.S. to have created fewer jobs last month at just 102,000 jobs versus 147,000 jobs in the prior month. And this has been the one bright spot in the economy, with the job market still beating expectations nearly every month. But if this one breaks down or gets closer to that 100,000 jobs estimate, it's going to signal a shift in the positive mood so far. Job creation of just 102,000 would mark the lowest since the recession scare of last October, and while it would put a Fed rate cut firmly on the table for September, would mark an economy closer to recession. And then most important, we get that August 1st deadline on tariff deals Friday, with the president saying that there will be no more extensions and threatening rates from 15 to as high as 50% on some countries. Up until now, the market has shrugged off these deadlines because Trump has always extended them or backed down to avoid a market disaster. I think he feels like he's backed into a corner now, though, and relying on the market to shrug it off again just seems like dangerous complacency. Now, against all this, earnings have been good so far, and the economy is holding up, so I'd never recommend selling all your stocks, but would maybe cover some positions with call options or buy puts on the SPY to protect from downside. Buying those put options on the S&P 500 ETF, the SPY, gives you broad downside protection on the market, but still leaves your stocks to take your portfolio higher, while selling call options against some of your stocks can keep some upside return intact while taking a little risk off the table and producing cash flow. Don't miss your chance to get a one-on-one portfolio review, free with the link in the description below. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.